What is Lorenzo 2 cents price target for HIMS? Let's get right into it. And you need to be a bit patient because I'm going to explain you why, how I got there before to tell you the number, right? So bear with me for a couple of minutes. So first, my thesis, you know that this is, if you have followed me so far, I'm using my 4 dimensions valuation framework, Lorenzo 2 cents dimensions, 4 dimensions valuation framework. So what does it mean? First dimension is the narrative, my thesis. I believe that HIMS is uniquely positioned to become basically the biggest healthcare AI company in the world. Why? Because they have a unique feedback data loop that is from patients intent to symptoms to diagnosis to treatment to outcome and so on, right? This is my thesis in short. Just go read my articles on lorenzo2cents.com to have a deeper insights on what I think about this. So given this thesis, because of course this valuation is starting from my thesis, not from the bullshit that analysts are saying, right? So let's start from here. This column, you basically have first the total addressable market. As total addressable market, I'm not taking the healthcare market, that of course can be considered the total addressable market. I think it's more useful to think about the global telehealth market minus China excluded. It gives a better understanding on where HIMS is playing. So currently, I have assumed it to be 150 billions. Normally, the range is between 130 to 200. I've taken 150 billion. It's not important, dollars, of course. It's not important the exact number. So with the revenue that HIMS have today, they have around 2% of market share of it. Now, this market is projected to grow 20% CAGR for the next probably 6-7 years. I have extended it to 10 years. It's pretty obvious to me that probably, if not most, but a big part of the healthcare market will eventually be telehealth, so from remote, right? Because of many dynamics that I'm not going to discuss now, but this is my prediction. So you have basically now you know that HIMS is playing in a market that is growing 20% annually for the foreseeable future. Now, I'm modeling, this is the normal case scenario. Normal case has 50% of chances of happening, according to me. So just to be sure, these are my assumption, okay? Qualitative and quantitative, as much accurate as they can be. So operating margin is now close to 0. It was closer to 5% a few quarters ago. And I'm estimating that there will be, recently in the last quarter, there was a write-off. So I'm estimating there can be around 5% for the next 2-3 years. So HIMS is investing a lot to grow. There is even pressure from competitors. So I think it will not go much higher than that. So 5%, and then we will grow over 10 years to 15%. I think this is a reasonable assumption. Let's make right now the parallel with the best case scenario that has 25% probability, and worst case scenario that is 25% as well. So here from 5 to 15, and for the best case is from 5 to 20, and for the worst case is from 5 to 12%. I think these are reasonable assumptions. Now, what other assumption? Okay, the conversion from operating cash flow to operating margin. Actually, the other way around. it's okay, now it's crazy, but because if this write-off is a big number, but I think it will be 200% at the beginning, as the cash flow, it's a leading indicator. So if the company grows, normally the cash flow is higher as a margin than the operating margin, and then it will go down to around 100%, so it's 130. Same assumption, more or less, is for the other scenarios. Then capex is pretty growing from now according to the revenue growth. So it's taking from the same formula that I'm using for the revenue growth. And yeah, interest paid actually and tax rate here just for references. They are not accounted in any way in the calculation because they are already considered in the operating margin. So now, growth for the next 5 years, I'm assuming 25% in the normal case scenario, so in the most likely scenario. Why 25%? I think, well, it's reasonable again. HIMS, before these last facts and dynamics about compounding GLP-1s and the other factors that led to revenue slowing, they were growing, I believe, around 50%. So it's reasonably to think they can resume growth around 25%. And 25%, by the way, it's slightly above the market growth. So if I believe, as I believe that HIMS is going to be the leader, of course, 25% is actually quite conservative. So 25% and 25% for the next 10 years, basically. Then from year 11 to 20, I'm assuming it slows to 18%, and then perpetual growth 10%. Again, we are talking here, probably this is after year 20. A market that will keep growing double digits for, I don't know, the next 20, 30 years, so 10% is pretty conservative. Now, just for reference, here, this is a discounted cash flow over 10 years. So you may wonder why, if this is a 10-year discounted cash flow, I'm even setting growth for year 11 to 20 and beyond. Well, these numbers are used in the calculation of the terminal multiple, that is in this case is 58. So terminal multiple means that basically is the value that you attribute at year 10 to the company. That is basically the free cash flow multiplied by the multiple. It's like the PE ratio, but it's a P to free cash flow ratio. That is what I'm using. So this terminal multiple, by the way, is very important. Actually, it's for growth company, it would make probably 70 to 80 to 90% of the value of the company. So this is basically the complete valuation, almost the complete valuation. So it's very important to be realistic about the growth that the company can have, not only from year for 10 years, but even beyond. Okay. Then how to be sure I've not made a big mistake? We have market share that after 10 years is still 2%, reasonable, and free cash flow margin it's 11%, so still reasonable. This tells me that probably I've not made big mistakes in my calculation. Okay, then best case scenario, 25%. Of course, here in the normal case, HIMS was showing his leadership in the market. In the best case, it's absolutely crashing it, right? As the market is still growing 20%, HIMS is growing 28% over the next 5 years and 27% over the second half of the decade. It's bullish. It's still plausible. I mean, guys, if you think first that HIMS was growing until 3 or quarters ago, 50% year over year. I mean, you have all these catalysts, you have peptides, you have GLP-1s. I think it's perfectly reasonable. If you have read my last update on HIMS that I've just published on lorenzo2cents.com, you will see that basically HIMS is most likely reaccelerating to 40% plus growth year over year through 2026. So it's perfectly doable, right? And it's bullish, of course, but it's doable. Then growth beyond year 10 is 22%, still slightly above the market probably, so it's still reasonable, and 12% perpetually after year 20. Of course, terminal multiple is very high, it's 163, but I mean, nothing if you see a company like Palantir or even Nebius, it's perfectly fine for high growth company that have a mode that can be defended. So it doesn't make me crazy, right? So free cash flow to revenue margin at year 10 is 21%, reasonable still, and 3% market share, pretty reasonable. Okay, and last, so normal case and best case, it's, I mean, the thesis that I'm outlining is confirmed, right? In the worst case or bear case, call it how you want, the thesis is rejected. So HIMS is still a good company. I mean, I'm not accounting for HIMS being a trash company or, I mean, underperforming so much the market, right? This is my thesis. I may be wrong, of course. So even here is growing slightly below the market. So it's losing or maintaining the market share, but it's not shining, right? And then you have after year 20, 8% growth. Pretty reasonable for a company that still is playing in this high growth market. And 4%, 5% free cash flow margin. Okay, so now, finally, you have your moment. Let's go to see what are the target prices with this assumption. So again, this is a discounted cash flow, which takes in consideration my assumption. Here you have the risk-free rate. I mean, some assumptions that more or less are quite constant here. Current market cap probably updated to a couple of days ago, so now could be slightly higher. And I'm expecting 3% annual dilution over the next 10 years, right? So it's in the math. Now, these are the numbers. Worst case scenario is basically $19, around 70% of current price. You have normal case scenario, $122, a 4x from here, and then you have best case scenario, 29x from here. So before you say you are crazy, these numbers are the range is too wide, you are shooting number in there, whatever. Guys, I told you my assumption. These prices are as reliable as my assumption. And before to say how HIMS, I mean, the classical question is, when are these target price? Now, I mean, this is the matrix of, here is written cash flow 2026, but of course it's LTM, last 12 trailing months. So it's Q1. So it's now, this discounted cash flow. The value that I'm determining now is now. So you may wonder, how can HIMS make 29x from now? Well, you need to understand that even though this is the trajectory of HIMS and it's pretty clear from now, meaning that you see reacceleration as the management guided for in Q2 and then Q3 and then Q4. Again, go read my estimates for revenue through the end of the year on my article on Lorenzo 2 cents. Even though this HIMS business progress exactly how I'm expecting, most likely the market is not going to price in the best case scenario because it's too uncertain. So you need even to make this kind of consideration. The numbers, the target prices I have found here are actually not target prices. I'm just calling like that so that you watch the video, but these are not target prices. These are target value for the company. So to the conclusion, I believe that the market could easily, it's never easy, but could easily price in the normal case scenario through the end of the year. So a forex is perfectly $100 and $120 is perfectly doable. Why? Well, because here this is built on the base of 25% growth over the next 5 years. So if HIMS accelerate to 40% growth year over year, as I expect through the end of the year, this scenario, of course, is easily priceable in, right? So a 4x by the end of the year is doable. Of course, it's much less probable a 29x or a 4x plus, just because the market is skeptics about this, cannot get what an AI native company is, cannot get what I have written in my article. So all in all, I think, I mean, the takeaway here is that in my view, and this is not financial advice, I may be wrong, I will be wrong. In my view, you have 70%, we have 70% plus of probability to see a 4x, see like this, by the end of the year. Why 70%? Well, because normal case is 4x, it's 50% of probability, while best case is 25%. So you have 50 plus 25% of probability to see $122 revenue share price by the end of the year or more, right? This is the takeaway. So if you want access to this Google Sheet, you can download it, check it and use it for your analysis. Just join the Business Ontology Community. You can find the link in the description or in the first comment. Ciao!